Hey guys, Sonya Bersani here with Legend Lending. Today, I'm going to teach you how to read a fees worksheet. Now, this is going to be a universal view. You might have an FHA, conventional, or VA loan, but the template's all the same and the numbers will just vary a little bit. But I'm going to go through and help you understand all of the cost involved to buy a home. Also, even more, what costs are associated to the lender that you're working with and what are associated to third parties. So this is going to be a pretty deep dive. I hope you stick with me to the end so you get a really good understanding of how these numbers all come together and equip yourself with the knowledge you need to really make some educated decisions, especially when you're comparing lenders. So let's go ahead and jump right into it. Okay, so this estimate that I'm going to go through today, this is an FHA loan, just so you know. But again, the format's all the same for any type of loan we're doing, but you'll see some number differences that I'll touch on. Now, the first thing I like to do when I'm looking at a loan estimate, ours in particular, and these are pretty universal, just so you know, with other lenders, I first like to start with the summary section, and then I get into all these detailed numbers you're seeing here. So if you have a fees worksheet from us, let me zoom out for a second. This is the full extent of it. This is what it looks like, okay? Now, again, the summary section is down here at the bottom, so I'm going to zoom in to that for a moment. Okay, so what you're seeing here is on the left-hand side, so we start over here with A through I. This is going to break out the total cost of you buying this home. So in this scenario, we're buying a home for $315,000. Our prepaid items, which are respective to usually taxes, insurances, and interest per day, on this estimate come to $46.35. You also have closing costs, right? Because closing costs are lender and title and some recording charges, whereas taxes and insurances are a whole other nugget. But your closing costs on this particular estimate were $6,091. And in this scenario, we're doing an FHA loan. So there is an upfront mortgage insurance premium being assessed on this deal of $53.19. The discount line. So this is super important. I'm going to show you where this comes in on the other side of this estimate up top here. But just to point this out, discount points are considered associated to the interest rate you're choosing. So this is typically a negotiable line, this discount fee, because what rate you want dictates if there's a price or not. So we'll talk about that a little bit. And I have other videos to help you understand how that stuff works with rates and points. So again, back to it on this particular home, $315,000 sales price, prepaid's $46,000, closing costs $6,000, mortgage insurance $5,300, discount fee, points that you're paying $45,000. So the total price tag on this home for this client was $335,605. So I like to look at it that way. What is the total cost to buy the home? All right, that's $335,000. Now from that, there's going to be credits and adjustments. So in the middle section here, you could see that we have some seller paid fees. So closing costs, seller paid $2,065. In this scenario, this is actually respective to the seller paying a title policy, which may or may not be the case for you. But in this scenario, it was. So $2,065 is going to be a credit back for this borrower. The borrower also put up $6,500 between option and earnest money. So that $6,500, again, is going to be credited back at closing. On this loan, we're lending 96.5%. So an FHA loan, our base loan amount is $303,975. On an FHA loan, there is that mortgage insurance premium, which you saw over here. And on an FHA loan, you are allowed to finance that in. So right here, you could see mortgage insurance, private mortgage insurance premium, funding fee, that covers all the government loans, finance, $5,300. So we're going to go ahead and finance that cost into our loan, which gives us a total loan amount of $309,294. Okay. Now, again, that's money that you're being lent, that's being given to you at closing. So a credit, right? So all of these credits against the total due are what bring you to $17,000. Because if you take your calculator and you do $335,000 less $2,065, less $6,500, less $309,294, the remaining due from you is going to be $17,746. Now, on any estimate you ever get with any lender, whatever that bottom line is, round it up. So if you were my client on this deal, I'd be telling you expect to need $18,000. If you want to even round it to 19, knock yourself out, gives you a little more padding. But you always want to create a little pad. Don't go dollar for dollar, cent for cent on an estimate, because it is just that, an estimate, okay? I'm going to come back to the payment section in a moment, but I want to keep on with explaining what these prepaids are and what these closing costs are. Now that you understand the summary, total cost, total credits, what's left over, right? Let's break into the actual itemization. Okay, so in this section, so this closing cost, we'll go over this one first, this $6,094. This is going to be a combination of all these fees with exception to this discount line, this $45.58. As you saw down here, the discount is a separate line item. And that's due to some regulations that came down, some compliance, so that consumers can see specifically what they're paying for an interest rate, okay? All right, so let's go back to the top. So I'll start actually from the top. So you'll see information up here that's pertinent to you. You can take a look at, right, how much you're borrowing, what rate you went with on this particular loan. You could see when it was prepared, who prepared it, etc. But okay, let's get into the meat of it here. So you go down this list. You have your discount points, which were associated to the rate that you chose, which may or may not apply if you were paying points. Then you have your admin and processing fees. So at Legend, these are our lender fees, right? Our paper pushing fees. So each lender usually has some type of lender fee, and that will all combine into what's called an origination cost, which I will explain in another video when I go over how to read a loan estimate, which is different than a fees worksheet. Okay, so you have your lender fees, admin and processing. You have an appraisal fee of $750. Now, appraisal fees are third-party fees, so lenders are going to estimate that cost and charge you an invoice when they get the bill. If it's a unique home, sometimes we'll quote $1,000 if it's a big home or you're trying to do a rush or something like that. Because again, appraisers are third-party contractors. So when we put that order out there, they're going to come back and say, here's how much I want right now to accommodate your request in 3 days or in 2 weeks. Okay. So again, third parties are all estimated charges. Credit report fee. We quote $90. It is less than that. But there's a little bit of padding in that as well, because if additional credit supplements are needed that you have to pay for, that can all be passed through to you as well. Your mortgage insurance, okay, again, that is a cost. Yes, we can finance it, but on an FHA loan, it's a cost and it's expressed as such. In this case, it was itemized out to be $53.19. FHA premiums are 1.75% of your base loan amount. So if you're borrowing $303, 1.75% of that is your FHA premium, okay? Texas attorney doc prep fee. So if you're buying a home in the state of Texas, there are attorneys involved that will draw up some of the closing paperwork, and lenders are going to pass through that cost to you. So again, $150 for potential attorney fees for drawing up some documents. And then this next section, you'll see everything starts with the word title. All of these fees, and now again, I'm the lender, but we prepare these estimates. So I am hedging third-party costs and padding them because I don't want you to be short at closing, right? But what they call one fee over another fee can vary title company to title company, but generally they're pretty regulated and usually really in line with one another. So don't get caught up too much on the exact name of the exact fee, but just know that these are all typical charges that have estimated costs associated. And again, we tend to quote high since they're third-party charges and we're not in control of those. So in this particular case, again, if you look at this entire title section, and you can go down the list. There's endorsement recordings, $2 a piece, settlement fees, and that could be, to use their closing room or their mobile notaries or whatever it might be. Again, they each have their own subset of what it covers. Lender's title insurance. So in this particular estimate, see this 1902? It's in the seller's column because in the contract, the seller agreed to pay the title policy. So in this case, it's moved over, but if the seller's not paying it, it would be in your column as a cost, okay? And the title policy, just so you know what that does, the title policy essentially protects you from any encumbrances, any ownership rights, any back liens or judgments. So when you're getting a mortgage, the mortgage companies will always require that you get a title policy because they want to be sure that there aren't any liens on the property, that there aren't people in the past who have ownership rights in this property. So that's what title insurance really is. So with this policy, if for an example, in 3 years from now, you get a bill from a taxing authority for a past due bill from years ago before you own the home, well, guess what? The title company would have to pay that because they insured you and us as the lender that that property was free and clear, okay? So the title policy is technically broken into two parts. There's an owner's title policy and a lender's title policy. So it's broken for coverage respective to those dollar amounts. So the lender's title policy is typically more expensive, right? Because the loan is generally the majority of the money you're using to buy the home. So you have the lender's title insurance policy. In this case, it was 1902. And then you have the owner's title policy of 163, because on this loan, we're only doing 3.5% down. So that's a much smaller portion. But not to confuse it, it's an insurance policy, and the endorsements and the way it's broken down are respective to money borrowed and money paid out of your own pocket. Okay. And again, in this case, the seller said they would pay for the title policy. So we have those moved over to the seller side. Other fees with the title company, again, you can see a couple dollar items here, 572. Those are generally for recording fees. Attorney fee, if the title company has an attorney, they retain, again, give or take, it may not be there depending on the title company. And then there's a bunch of endorsements down here. So to that title policy, once everything's recorded with the deed at the courthouse, there may be additional documents that have to be recorded, like if you're in a planned unit development and there's associations involved. And then there's other things like deed restrictions, tax deletions, environmental protection. These are just other documents that are going to be added to the policy. And the title companies can give you more elaborate detail on what they are if you're really interested. Okay. So now that we're out of the title fees, now we're on to survey. So in Texas, a survey is always required. A lot of times the seller will already have a survey that they'll hand over to you, but they may not. So we always quote for a survey. And depending on the size of your property, acreage and such, just know that that survey cost sometimes, it might be $1,000 because surveys on larger parcels can be more expensive, or in rural areas. But the survey cost, part of your sales contract, broke out who was responsible for your survey cost. Okay. Again, normally the seller has a survey and they pass it over to you. And as long as there's been no major changes to the layout of that property, like additions, pools, outbuildings, things like that, driveways, if there's been no work done to the property since that seller had that survey done, 9 times out of 10, the survey is acceptable. Nobody has to pay any money. We just use that survey again. But if there is an issue with the survey, there was an addition put on, maybe the surveyor didn't notarize the document, that can all be a situation where there'd be a new survey required. And that's where what was in your sales contract will dictate if you're responsible for it or if the seller is. So we as a lender always put it as a borrower cost because we want to be on the safe side and give you some padding. Recording fees at the courthouse. So this $250 at the bottom line, again, third-party estimate, we're estimating what the county is going to charge to record these documents at settlement. They record a bunch of documents, right? Your deed, your mortgage and such. So, they charge per page. So it's about $250. So now just to stop here, I talk a lot really fast, I know. All of these fees that I'm going to highlight here, these are considered closing costs. Closing costs consider, again, lender and title and some third-party recording expenses, okay? The interest rate discount in and of itself is a lender-related fee, okay? But it's an elective, all right? When you get a loan estimate, so when you're shopping for a home or you're just in the beginning process, you will likely get just something like this, a fees worksheet or an estimate. When the loan is initiated and there's a property associated, you're going to receive a loan estimate. Now, a loan estimate is going to take all the numbers that are on these fees worksheet and put it into a universal format that all lenders are required to use. The format's good for people who are familiar with it, but it can be a little bit more confusing than looking at a fees worksheet. So what I will tell you is this: when you are shopping lender to lender, the most important thing you want to do is find out what your origination costs are. Now, on this fees worksheet, you don't see the word origination, do you? That's because that shows up on your loan estimate. But the origination cost is a combination of two things: lender fees and what you're paying or not paying for your interest rate. So in this scenario, the only lender fees for paper pushing are the admin and processing fee. Okay, so I have those two to account for. So $9.99 plus $4.99. And in this scenario, the buyer elected to buy his interest rate down to 5%, which the day he was locking would cost $4,558. So I add that. So technically, this borrower is getting a 5% rate with a $6,056 origination fee. Okay, again, the combination of the lender fees for paper pushing and the interest rate. That's your origination cost. So when you're shopping lender to lender, you want to look at what the rate is and the origination cost. Okay, that'll give you a much clearer view. And I'd also encourage you to try to shop the same rate or the same origination cost, because it's a two-sided coin. You can always get whatever rate you want. It's a matter of what you're paying for it or not paying for it. And if you can't compare an apple to apple with lender to lender, it's really difficult to know where you're getting a better deal. Another thing on your loan estimate you're going to get is your APR. You can always ask your lender for your APR as well. When you're at this stage, they should be able to produce that for you. Just know that APR also would include any mortgage insurance you're paying. So in an FHA loan, that APR can be a lot higher than the APR can be a lot higher than it would be on a conventional loan without mortgage insurance. But nonetheless, this is the nitty gritty. And that's why I like looking at this. What are the dollars? Because you can have an APR that is very close to an interest rate and not realize that there's thousands of dollars of cost in there that may or may not make sense. Okay. All right. So back to it. All of these are your closing costs. And then at the top is your discount fee, which was an elective. So that comes in down here, right? So this $6,091, it's a combination of all these charges. And then the $4,558 is right up top. All right. Now, the other fee down here that we need to talk about are the prepaids, this $46.35. Okay. So this $46.35 is a combination of this section here in the middle. And this is inclusive of taxes, insurances, and interest per diems. Okay. So to start from the top, and just to explain this for a moment, with an FHA loan and the majority of loans that are done where there's, in particular, not 20% down, escrows are included. Taxes and insurances will be included in your loan. So taxes and insurances, the way they're paid and collected can be a little bit confusing. I'll give you an example. With homeowners insurance, it is required that you pay a full year of homeowners insurance right at the settlement table for the year ahead. Okay, so in this estimate, that's basically shown here. Hazard insurance, also known as homeowners insurance. For one full year, we were estimating for this guy, it would be $1,890. So he's going to bring $1,890 right to the settlement table. He's paid out for a year. And what's going to happen every single month, he's going to put in $157 down here in his payment each month. He's going to put in $157. And then next year, when this insurance bill comes due again for the following year, we have enough money saved up to pay that bill again. Okay. But when you close on a home, like if you're closing in June, your first mortgage payment's not until August. You skip 1 month, and you don't technically skip it. You just pay for that month in the month ahead. So if you're closing in you're closing in June, July 1st comes around, there's nothing to pay because anything that was due for May was paid at the table. I'll show you that in a minute. So July 1 rolls around, and that will pay for the month of June. So you pay your mortgage in arrears. And I'm telling you that because back to this insurance example, when you pay a full year of insurance ahead, and then you start putting in 1/12 each month, you skip 1 month. So 1 month has to be collected right at closing for your escrow account, which is essentially your savings account, right? Your savings account will hold all the tax and insurance money for future payouts. No, there is no interest paid out on escrow accounts. But I will tell you there's a convenience factor. I prefer escrowing. Do not want to deal with big bills at the end of the year or at any point during the year. So at closing, what you're going to see is that lenders are going to quote you a couple of months of homeowners insurance at closing, in addition to you paying a full year. One of the months that they're collecting is to take place of that 1 month that you're going to skip. And then there's a 2-month cushion generally held in any escrow account at any time. Legally, it cannot be more than 2 months worth of the actual proration on a monthly basis. So in essence, you can't have more than 2 months of taxes and insurance money in your escrow as extra at any given point. So what a lender is going to do is they're going to estimate, right, say 3 months of insurance they're going to have to collect. And then we're also going to collect some money for taxes. Okay. Now, here's the thing. In the initial stages of you getting quoted for a loan, the taxes that are due, and there's multiple jurisdictions that are paid, there's county and all that jazz, that will all be broken down to a per diem by the title company. So the title company, in addition to insuring you to make sure this property is free and clear, they're also going to verify all taxes are current, paid, and when they're due again. So when they get all the tax certifications done, they're going to talk with the lender and we're going to figure out exactly how much has to be collected to be sure that your escrow account is sufficient to pay future tax bills. Now, in Texas, no matter what time of year it is, generally speaking, you always need about 3 months worth of taxes. You'll see this broken out in much more detail with prorations and aggregate adjustments and all these fancy words, but I'm going to put it simple. You need about 3 months of taxes at the table. Okay. So we're going to put that here as well. Now you will see this, this word aggregate adjustment. People get super confused by it. So you'll see there's just a small aggregate adjustment of 4 cents back to you. An aggregate adjustment is as your loan is firmed up with all those numbers from the title company with taxes and you get your insurance in place, there's an algorithm, like the escrow account itself does a projection. So you start out with a certain amount of money and then we put in there when the bills are going to be due, how much they are, and it'll compare that against how much is going to be in the account when that time comes. And if it projects out and sees that we're going to have an overage, we're going to be over that 2-month cap I told you about, the algorithm will spit out what needs to be adjusted, how much less we need to collect at closing. So you'll even see on your final settlement sheet, you'll see the collection for taxes and insurances, and then it'll say, whoop, aggregate back. It could be $1,000, it could be 4 cents, whatever it is, there's going to be an adjustment so that we're not over collecting for your escrow account. So that's what an aggregate is. Your daily interest per day. So your daily interest charge, this is coming back to you skipping a monthly payment. Remember I said that? Well, if you're closing in, we said June, right? If you're closing in June, and let's say you're closing June 2nd or 1st even, okay? Right in the beginning of June. When you go to the settlement table, because we're lending you the money as of that day, we're going to collect the interest for the remainder of that month on the money that we've lent you. So in this particular scenario, and your interest per day, by the way, is calculated by taking your loan amount. So in this case, 309,294 times 5%, and then divide that by, say, 365 days. Okay. So if you take that and you divide it, I did that math very wrong there. I'll change that again. Oh, I'll just trust me on this one. Your interest per day on 5% on a $309,000 loan is about $42 a day. So $42 a day for 29 days. We're going to collect that money right at closing. That's going to cover you for the remainder of June. So when July 1 rolls around, there's no interest to pay because you paid it at closing, you see. So July 1, there's no bill. August 1, you pay for July. So that's why you technically skip this payment. But again, you're paying in arrears. Okay, so this middle section, this is again considered your prepaid and escrow section, which down here was this 4635 figure. All right. So just to once again recap it, now that you know what all those fees are, the summary puts it all in perspective. Purchase price plus your prepaids and escrows plus your closing costs plus any insurance premiums, like if it's FHA or if there's funding fees on VA, plus any discount points if you've paid money for your interest rate. All of that goes into how much it costs you to buy that home. So in this one, $335. And then you apply your credits, what the seller's paying, what you've put on deposit, what the lender is covering and or financing, okay? All those credits against what is owed is how much cash you need at the table. Then the last piece on your estimate you'll see is your actual payment. So you have it broken out. Here's your principal and interest. Here's your hazard/homeowners insurance, $157. Here's your taxes, $348 a month. Mortgage insurance, if it applies for you, would be there. Now, HOA dues, HOA fees are technically not going to be in your mortgage payment, but they will be you will be qualified with them. So you will see if you're buying a home in a homeowners association, lenders are usually going to have a prorated amount in your monthly payment on your paperwork purely for qualifying, but you do not pay that in your payment. So that'll be separate. So the technical bill this person's going to get, if everything was exactly correct on this estimate, would be $2379.90. Okay. So I hope this is helpful. Definitely, again, just a quick couple reminders when you're comparing lenders, interest rate discounts and any paper pushing fees, those equal your origination cost. Everything else is third party. And that's why you do not want to compare one lender to another purely based on bottom line. Because if you do, what's going to happen is you're going to realize maybe one lender underquoted your homeowner's insurance, or maybe one lender underquoted the title fees. And that's just that kind of stinks because you want to be over prepared, right? So don't compare lenders by bottom lines, compare lenders by origination cost and interest rate, and make sure that your lender, if you're seeing a disparity on bottom lines pretty drastically, you want to be sure the lender you're going with has valid third-party expenses that aren't underquoted and will leave you short at the table. I hope this is helpful, guys. And if I can do anything else to help you or my team can, always feel free to reach out. Take care.